Hey y'all, it's Jordan. I get so many requests to make a video like this, so today's the day I'm gonna do it. The IRS is starting to crack down on cryptocurrency reporting and taxes for individuals, and it is important that you know exactly what to expect when it comes tax time. The first question I always get asked is, do I have to file and pay taxes on my cryptocurrency activity? For the 2020 tax filing season, there was even a question that was required to be answered on each tax return. It went something like this. At any point during 2020, did you receive, send, sell, exchange, or otherwise acquire financial interest in any virtual currency? The IRS defines cryptocurrency, or virtual currency as they say on their website, as digital representation of value. Crypto is treated as property according to the IRS, and so the general tax principles that apply to property transactions also apply to crypto. You can think about some of these things through the lens of owning real estate, although we will see that crypto doesn't enjoy all of the tax benefits that real estate does. There will be US taxes assessed on any income or gains from cryptocurrency. For example, if you realize a gain on the sale of a crypto, or if you earn interest, for example, for staking your crypto, those would both trigger taxable events and require taxes to be paid. You will need to include your cryptocurrency activity on your tax return if you sold crypto back into US dollars, if you traded one crypto for another, such as exchanging Bitcoin for Ethereum. You'll also have to report it if you spent crypto on any goods or services. That happens on a different form, not necessarily on your tax return. And lastly, if you received crypto as income for maybe mining different coins or services provided, or if you were staking any of your coins, if you received more crypto as income, you'll have to report that as well. So you can think about this as it applies to real property. If someone paid you with a piece of real estate, that would be taxable. If you exchanged one piece of real estate for another, that could be taxable. But in the crypto world, an exchange like that will always be taxable because as of now, 1031 exchanges are not permitted for crypto exchanges. Selling your crypto for cash would be similar to selling a rental property, and we would have to know the sale price and the cost basis to determine if there's a gain or a loss on the sale. Spending your crypto for goods or services would fall into that 1099 reporting category, which just helps the IRS ensure that all financial transactions for services above $600 are reported. Events that are not taxed include transferring crypto between wallets or exchanges. So when I send Bitcoin from the exchange I bought it on to my Ledger cold storage, that's not a taxable event. Let's talk about gifting crypto, because this can get really tricky depending on the timing and depending on how the market is doing. We have to determine the cost basis of the gifted property, in this case, crypto. So the general rule is that property acquired as a gift will generally retain the cost basis it had while in the hands of the donor at the time of the gift. Say you had an uncle who bought one Bitcoin back in 2012 for like $5 and held it until 2021 when he gifted it to you. Lucky you, right? That would mean that your cost basis in the gifted Bitcoin is $5. And if you go to sell it, then your taxable gain would be the selling price for one Bitcoin minus your basis of $5. And your holding period, which is the time between the date of the gift and the date of your sale, would determine if it's a short-term or a long-term gain. Long-term gains have lower tax rates as the law is written today. The confusion with the cost basis as it pertains to gifts starts if the fair market value of the crypto is lower than the donor's basis at the time of the gift. Now let's say your uncle bought one Bitcoin at the all-time high as of this video, which was in April of this year, and he paid $64,000 for the coin. And here in October of the same year, he gifts that one Bitcoin to you while Bitcoin is currently worth, when I checked this morning, I think it was like $55,000. In that case, there's an exception to the cost basis rule, and the basis will depend on what you sell the Bitcoin for, since the fair market value of the coin is less than the donor's basis. Remember, we're just trying to determine the cost basis for calculating the gain or loss on your sale of the gifted crypto. The equation for the gain or loss is just sale price minus your cost basis, and that's going to equal your gain or your loss. So in the case of this exception, which is not all that uncommon given the volatility of crypto generally, the cost basis will depend on the selling price of Bitcoin. Let's take scenario one. So you wait until the end of 2021 and you sell the Bitcoin for $100,000. In this case, your basis would be the same as the donor's basis. Remember when he bought it at the all-time high. So your gain would be $100,000. That's what you sold it for, minus the $64,000, which is the donor's basis, and your gain would be $36,000 at that point. And that would be considered a short-term gain since you held it for less than 1 year. Now let's say scenario 2, you sell the Bitcoin in October of 2021 for $60,000. Since the sale price is between the donor's cost basis of $64,000 and the fair market value at the date of the gift, which was $55,000, there is no gain or loss. Okay, lastly, we're going to talk about scenario 3. Let's say Bitcoin just starts to plummet because of a slew of Elon tweets in November of 2021, and you panic sell the one Bitcoin and you sell it for $49,000. In this case, you would use the fair market value at the time of the gift as your basis for determining your loss. So the loss would be calculated as $49,000 minus $55,000, your basis, to give you a short-term capital loss of $6,000, which can be used to offset other short-term capital gains you might have had during the year. If you had no other gains, and assuming you're married, you can take up to $3,000 of capital losses on your return in one tax year. And then you would roll the other $3,000 of loss to be used in the next tax year to either again offset gains, or it can be taken as a loss up to the current limit of $3,000 per year. Lots of information there, but it's important to know this before you make any decisions regarding crypto that was gifted to you. If you hold the crypto for more than 1 year before selling the gifted crypto, you're likely going to see more gains in the asset, and you will have more favorable tax rates applied to your gain as the law stands today for those long-term capital gains rates. Because the short-term gains are taxed at ordinary tax rates, which the highest right now is that 37%, depending on your income. And long-term capital gains rates are taxed at a max of 20%, also depending on your income. So just to give you an example, that means if you had $500,000 of gains on the sale of a crypto, the benefit of holding it for 1 year versus selling it within a year would be $85,000 saved in taxes just for lengthening your holding period to more than 1 year. Now, the gift rules do not apply to inherited property. If you inherit one Bitcoin and you assume the same assumptions as before, the cost basis gets what's called a step up in basis to the fair market value at the date of death. This means that that Bitcoin that your uncle bought for $5 in 2012 would get a step up in basis to $55,000 in October of 2021 if you receive it after his death as an inheritance. Then if you sold the same coin for $55,000 the next week, the gain would be zero because the equation would be $55,000 selling price minus $55,000 cost basis, and that equals a $0 gain. So the timing component of the transfer of property is extremely important. And assuming you're able to sell at a price of $55,000, the capital gain tax difference between gifted property, maybe the day before your uncle died, versus the inherited property the day after he dies, it's about a $20,000 tax difference. So the inheritance would result in a $0 tax bill with those assumptions, while selling a gifted Bitcoin would have a $20,000 tax bill. And this was calculated using $55,000 as your selling price minus $5 cost basis times that top tax rate of 37%. The gift itself is not going to be taxable as long as the fair market value of the gift is less than $15,000. You're allowed to gift someone $15,000 a year with no reporting or tax consequences for the gift itself. The taxes for gifts under $15,000 come into play after the gift, and they depend on if you receive income because of the gift, think like interest from a gifted stable coin that is staked, or the sale of a gifted coin after you receive it. If you gift someone more than the $15,000 max, then you have to report it, and it goes against the donor's lifetime gift tax exemption. Okay, that is it for the crypto, gifts, or inheritance. Let's get back to crypto that you purchased. So tracking the gains and losses between sales or exchanges of different cryptos is the most complicated part of all this, especially given that crypto exchanges are trying to figure out their own reporting requirements as well. For that reason, you need to use a crypto tax tracking software like Token Tax or Coin Tracker to generate a Form 8949 with all the trade history for the year. This will make your life a lot easier come tax time, and you will be sure that you're staying in compliance with the current tax laws. These tools connect to the different exchanges that you buy crypto on, and then they import the trading data and track your capital gains and losses. And there's even ways to get suggestions on tax loss harvesting your crypto to be able to offset some of your gains. I hope that helps to answer some of your crypto tax questions. What are some other questions that you have regarding this issue? Drop them as a comment, and we will be sure to make another video as soon as possible to answer those. Thank you so much for watching, and I'll talk to you again very soon.